If you inherit an IRA, what you do in the next 10 years will determine whether your heirs pay $30,000 in taxes or $160,000. The difference is not an accident. It's math. And most people never do the math until it's too late. Subscribe to this channel right now. Hit the bell. Turn on notifications. Jennifer is 42 years old. She lives in California. She works as a marketing director. She makes $85,000 a year. Her life is normal. Her job is stable. Her retirement is years away. Then her mother passed away. The bank sent Jennifer a certified letter. Inside was one number, $500,000. That was her mother's traditional IRA. Her mother had spent 35 years building that account. Every paycheck, she put something aside. Every raise, she increased her contributions. Every bonus, it went into the IRA. For 35 years, her mother made the hard decisions. She deferred gratification. She saved when it was inconvenient. She did not retire wealthy by accident. The letter said Jennifer had 10 years to distribute the account. 10 years. That sounded like forever to Jennifer. She thought, I have time. I don't need this money right now. I'll deal with it later when I'm closer to retirement. I'll figure out a strategy then. She set the letter aside. She had no idea what was about to happen. Jennifer did nothing for 9 years. She left the money in the inherited IRA. She did not think about it. She did not plan for it. She did not talk to anyone about it. It just sat there. The account grew a little. Some years it shrank. But Jennifer paid no attention. Then year 10 arrived. The December 31st deadline was looming. Jennifer looked at her inherited IRA statement. The account balance had grown to $550,000. Her mother's careful saving had turned into more money through investment growth. And now Jennifer had to take it all out by December 31st. Jennifer withdrew the entire $550,000 in one calendar year. Her income that year exploded. She made $85,000 from her job. She withdrew $550,000 from the inherited IRA. Her total income was $635,000. $635,000 in a single year. That put her in the top federal tax bracket. 37% federal tax. California taxed her at 8.82%. Combined, she was paying 45% in taxes. Her tax bill that year was $247,000. $247,000 on inheritance that was supposed to be hers. But here's where it gets worse. That $635,000 income spike created a second problem. It triggered Medicare IRMAA surcharges. IRMAA is income-related Medicare adjustment. It means that if your income is high enough, your Medicare Part B premiums go up. Way up. Jennifer's income pushed her into the highest IRMAA tier. Her Medicare premium jumped from $165 a month to over $500 a month. That extra $300 a month went on for 2 years. Because the IRS uses a 2-year look back to calculate Medicare premiums. The year 10 withdrawal triggered Medicare surcharges in year 12 and year 13. $6,816 in extra Medicare premiums. Medicare surcharges that had nothing to do with her actual health or Medicare usage. They were purely because her income spiked one time. Her real total cost was $247,000 in federal taxes, plus $8,000 in California state taxes, plus $6,816 in Medicare surcharges. Total, $261,816. Jennifer inherited $550,000. After taxes and Medicare surcharges, she had $288,000 left. The government took $261,000, nearly 50%. Almost half of her inheritance disappeared. But here's the thing. Jennifer could have done this differently. She could have withdrawn $50,000 every single year for 10 years. The exact same $550,000 inheritance. Different strategy. Same money. Completely different outcome. If Jennifer had spread the withdrawals, her income would have been $85,000 from her job plus $50,000 from the inherited IRA, equaling $135,000 total each year. She would have stayed in the 24% federal bracket. Combined with California state taxes, she would have paid 32%. $50,000 per year times 32% equals $16,000 in taxes per year. Over 10 years, that is $160,000 in total taxes. Compare that. $247,000 if she takes it all in year 10. $160,000 if she spreads it over 10 years. The difference is $87,000. $87,000 in taxes on the exact same $550,000 inheritance. Plus, she would have had no Medicare IRMAA surcharge because her income never spiked. She stayed in the $135,000 range. That does not trigger the highest IRMAA tiers. Her real total would have been $160,000 in taxes and $0 in Medicare surcharges. $87,000 less. Jennifer lost $87,000 because nobody explained how inherited IRAs work under the Secure 2.0 rules. Nobody explained that December 31st of year 10 is a hard deadline. Nobody explained that the IRS doesn't care how you empty the account, only that it's completely empty by that date. That is the inherited IRA tax bomb. And if you inherit one, I'm about to show you exactly how to disarm it before December 31st of year 10 arrives. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. Let me explain what the IRS changed in 2024 because it changed everything, and most people don't understand what changed. And if you're going to inherit an IRA, you need to understand this before you inherit it, not after. Before 2024, inherited IRAs were called stretch IRAs. That was the nickname. And here's why. The original owner of the IRA could die. Their heir could inherit it, and the account would stretch over the heir's lifetime. If you inherited at age 42, the account could grow for 40 years. Your heirs could inherit it when you died. Their heirs could inherit it. The original owner died in 1990, but the account was still growing in 2022. That was the stretch IRA. The account never died. That was the old rule. In 2024, the IRS changed the rule completely. The Secure 2.0 Act said this. If you inherit an IRA and you are not the spouse of the original owner, you have exactly 10 years to take everything out. All of it. Every single dollar. By December 31st of year 10. That's the deadline. No extensions. No negotiations. The account must be empty. But here's where the trap happens. And this is the part that cost people the most money. The IRS did not say you must take equal amounts every year. The IRS did not say you must take a percentage every year. The IRS said the account must be empty in 10 years. But how you empty it is completely up to you. Most heirs don't know this. Most heirs think the IRS requires equal distributions every year. So they think they must take $50,000 a year if they inherited $500,000. Or they think they can take nothing for 9 years and then take everything in year 10. And technically, they're right. They can take nothing in year 1, take nothing in year 2, year 3, 4, 5, 6, 7, 8, 9. Take absolutely nothing. Then in year 10, take every single dollar. The IRS won't stop you. That's technically legal. But here's what happens when you do that. And this is where the math gets brutal. You inherit $550,000 at age 42. You leave it completely alone. It grows. The account is now worth $550,000 by year 10. You withdraw $550,000 in 1 calendar year. Your income goes from $85,000 to $635,000. You hit the top tax bracket. The IRS taxes you at 37% federal, plus your state taxes you. If you're in California, that's 8.82% state. Combined, you're paying 45% in taxes on $550,000. That's $247,000 in taxes on inheritance that was supposed to be yours. But if you had withdrawn $50,000 every single year, your income stays at $135,000. You stay in the 24% federal bracket. You pay 24% federal plus 8% state. You pay 32% in combined taxes on the same $550,000. Over 10 years, that's $160,000 in taxes. The difference is $87,000. $87,000 in taxes you don't have to pay. If you do the math, if you understand the rule, if you plan before year 10 arrives. And there's more happening in the background. When you take that huge distribution in year 10, your income spikes. That income spike triggers Medicare IRMAA surcharges. Your Medicare premiums go up, not just for 1 year, for 2 years, because the IRS uses a 2-year look back. You withdraw $550,000 in year 10. Your Medicare premiums spike in year 12 and year 13. That's $284 extra per month. For 2 years, that's $6,816 in Medicare surcharges you didn't know were coming. So your real tax bill is $247,000 in income tax, plus California state taxes, plus $6,816 in Medicare surcharges. That's $261,816. That's the real cost of waiting until year 10. If you spread the withdrawals over 10 years, your tax bill is $160,000 in income tax and $0 in Medicare surcharges. Zero. Because your income never spikes. The difference is $87,000 plus $6,816. That's $93,816. That's nearly $100,000. Lost because nobody explained how inherited IRAs work in 2024. Nobody explained that December 31st of year 10 is a hard deadline. Nobody explained that the IRS doesn't care how you empty the account, only that it's empty. That's why I'm telling you this today. Before you inherit. Before you wait until year 10. Before you lose $90,000 that belongs to you. Let me show you exactly how this works. I'm going to walk through 3 real scenarios with real people at different income levels. Real tax brackets. Real IRMAA surcharges. Real dollars. Scenario 1. Jennifer, age 42. She inherits her mother's traditional IRA in 2026. The account has $500,000 in it. We just walked through her story. But let me put exact numbers on it. Jennifer's current income is $85,000 from her job. She lives in California. She does not need the inherited money. She thinks she'll just wait until year 10. Here's what happens if she waits until year 10. Year 10 arrives. Jennifer withdraws $550,000. Her income that year is $85,000 plus $550,000. That's $635,000 total. At $635,000, Jennifer is in the 37% federal tax bracket. California taxes her at 8.82%. Combined, she's paying 45.82% of that $550,000 withdrawal. That's $251,000 in federal and state taxes combined. But it doesn't stop there. That income spiked so high that it triggers the Medicare IRMAA calculation. Jennifer turns Medicare eligible 2 years later. Her Medicare Part B premium jumps from $165 a month to over $500 a month. That's an extra $335 per month. For 2 years, that's $1,240 times 2. That's $2,480 in extra Medicare premiums. Actually, let me recalculate that more carefully. $335 per month times 24 months equals $8,040 in Medicare surcharges. Her total cost is $251,000 in income and state taxes plus $8,040 in Medicare surcharges. That's $259,040. She inherited $550,000. After taxes and Medicare surcharges, she has $290,960 left. The government took $259,000, nearly 50% of her inheritance. Now let me show you what happens if Jennifer spreads the withdrawal. Instead of taking $550,000 in year 10, Jennifer takes $55,000 every single year from year 1 through year 10. The same $550,000 inheritance spread over 10 years. Year 1, she withdraws $55,000. Her income is $85,000 plus $55,000. That's $140,000 total. She's in the 24% federal bracket. California is 8.82%. Combined, she's paying 32.82%. That's $18,100 in taxes that year, just from the $55,000 withdrawal. She does the same thing year 2. $55,000 withdrawal, $18,100 in taxes. Same in year 3. Same in year 4. All the way through year 10. Over 10 years, spreading the same $550,000 withdrawal, she pays $181,000 in total taxes. Here's the difference. $251,000 if she waits until year 10. $181,000 if she spreads it. The difference is $70,000. $70,000 in taxes on the exact same $550,000 inheritance. And she doesn't have the Medicare surcharge problem because she's never taking a huge income spike. Her income stays at $140,000. That doesn't trigger the Medicare IRMAA surcharge. Her real total is $70,000 in taxes saved, plus zero in Medicare surcharges. $70,000 in her pocket instead of the government's. That is scenario 1, and that's why the math matters. Scenario 2. David, age 35. He inherits his father's traditional IRA in 2026. The account has $800,000. David makes $120,000 in salary. He works in technology. He lives in Texas. Texas has 0% state income tax. That's important. David is young. He has a strong career. He doesn't need this inheritance to live. He thinks he'll just leave it alone and use it later when he retires. So he does nothing for 9 years. Year 10 arrives. David withdraws the entire $800,000. His income that year is $120,000 plus $800,000. That's $920,000. At $920,000, David is in the 35% federal bracket. He has no state tax in Texas. He pays 35% of that $800,000 withdrawal, $280,000. That's his tax bill that year. But David also triggers the IRMAA Medicare problem. $800,000 in a single year is an enormous income spike. 2 years later, his Medicare premiums jump, an extra $300 per month. For 2 years, that's $7,200 in Medicare surcharges. His total cost is $280,000 in taxes plus $7,200 in Medicare premiums. That's $287,200 lost. David inherited $800,000. After taxes and Medicare surcharges, he has $512,800 left. The government took $287,000, 36%, over 1/3 of his inheritance. Now here's what happens if David spreads the withdrawal. David takes $80,000 every year for 10 years. His income each year is $120,000 plus $80,000. That's $200,000 total. At $200,000, David is in the 24% federal bracket. No state tax. He pays 24%. That's $19,200 in taxes that year. He does the same thing years 2 through 10. Over 10 years, that's $192,000 in total taxes. Here's the difference. $280,000 if he waits. $192,000 if he spreads. That's $88,000 in taxes saved. $88,000 in taxes on the exact same $800,000 inheritance. Plus, he eliminates the $7,200 Medicare surcharge. Total savings, $88,000 plus $7,200. That's $95,200. $95,000 in David's pocket instead of sent to the IRS and Medicare. David is 35 years old. He has 30 years of working life left. He could use $95,000 to fund his future retirement, to invest, to build. That $95,000 is his father's legacy to him, not the government's. That is scenario 2. Scenario 3. This one is more complicated, but it shows you why this matters for couples with large inheritances. Robert and Maria are both age 68. They're married. They retire together in 2026. Robert's mother passes away and leaves Robert a traditional IRA. The account has $1,200,000. Robert is the sole beneficiary. His mother spent 40 years building this account. Robert and Maria's current income together is $80,000. Social Security, $50,000. Robert's pension, $30,000. They have no debt. They don't need more money. They think they'll just take the money out in year 10 when they have to. Year 10 arrives. Robert and Maria withdraw $1,200,000. Their household income is $80,000 plus $1,200,000. That's $1,280,000. At $1,280,000 of household income, they're in the top tax bracket, 37% federal. Combined with state taxes, they're paying 45% on that $1,200,000 withdrawal, $454,000 in federal taxes alone. Add state taxes. Their total is over $500,000. But there's more. That income spike triggers IRMAA surcharges for both Robert and Maria. Both of their Medicare premiums spike. Both of them are in the highest IRMAA tier, $589 extra per month each. For 2 years, that's over $28,000 in combined Medicare surcharges. Their total cost is $500,000 in taxes plus $28,000 in Medicare surcharges. That's $528,000. They inherited $1,200,000. After taxes and Medicare surcharges, they have $672,000 left. The IRS and Medicare took $528,000, 44%, nearly half their inheritance. Now here's what happens if Robert and Maria spread the withdrawal. They take $120,000 every year for 10 years. Their household income every year is $80,000 plus $120,000. That's $200,000 total. At $200,000 in household income, they're in the 32% federal bracket. Combined with state taxes, they're paying 38%. That's $45,600 in taxes that year, just from the $120,000 withdrawal. They do the same thing years 2 through 10. Over 10 years, that's $456,000 in total taxes. Here's the difference. $500,000 if they wait until year 10. $456,000 if they spread over 10 years. Wait, that's not much of a difference. Why? Because they're in a high tax bracket either way. The spreading saves them a little bit on the taxes, but the real savings is the Medicare surcharge. If they spread the withdrawal, their income stays at $200,000. That does not trigger the highest IRMAA tier. They might be in Tier 2 or Tier 3. The surcharge is maybe $90 per month extra, not $589. That's $12,000 less in Medicare surcharges. $12,000. So their real total is $44,000 in taxes saved, plus $12,000 in Medicare surcharges saved. That's $56,000 on a $1,200,000 inheritance. $56,000. That's a car. That's a roof. That's early retirement for one of them. The math matters, especially at scale, especially for couples, especially for large inheritances. That is scenario 3. Here's what you need to do if you've inherited an IRA, or if you're about to inherit one, or if you think you might inherit one in the future. These are the specific actions, not a checklist of fears, but actionable steps. Step 1. Call your bank today. Call Fidelity. Call Schwab. Call Vanguard. Call whoever is holding the inherited IRA. Ask them this exact question. I am a non-spouse beneficiary of an inherited IRA. What are my distribution options under the Secure 2.0 rule? They will tell you about the 10-year rule. They will tell you the December 31st of year 10 deadline. Write it down. Mark it on your calendar. You need to know this deadline. It is your deadline. It is not negotiable. It is not flexible. December 31st of year 10. That's your hard stop. Step 2. Get your inherited IRA custodial statement from the date of death. This shows the original balance. This shows you as the beneficiary. This proves you inherited it. Save this document. You'll need it for tax purposes. You'll need it to track your withdrawals. Keep it forever. Step 3. Open a spreadsheet or a piece of paper. Write down 3 columns. Year. Age at that year. Projected income that year. Fill in all 10 years. Year 1. Your age. Your projected income for year 1. Year 2. Your age plus 1. Your projected income. All the way to year 10. This is your planning spreadsheet. This is going to show you how much you can withdraw every year while staying in a lower tax bracket. Step 4. Calculate your tax bracket each year. Look up the IRS tax brackets for each year from 2026 forward. Your projected income tells you which bracket you'll be in. Step 5. Calculate how much you can withdraw every year without jumping to the next higher bracket. Here's an example. Your income is $85,000. The 24% bracket goes from $47,000 to $100,000. You have $15,000 of room in that bracket. You can withdraw up to $15,000 without jumping to the 32% bracket. Do you need the money? Do you want it for lifestyle? Great. Withdraw $15,000. That year, from the inherited IRA, take $15,000. You stay in the 24% bracket. You pay the low rate on the withdrawal. You're doing this deliberately. You're doing this with math. You're not taking a $500,000 lump sum in year 10 and paying 45% in taxes. Step 6. Set up automatic distributions from your custodian. Don't leave this to chance. Don't wait until December to think about it. Every January, your custodian automatically distributes whatever amount you calculated. January 15th, $50,000 comes out. January 15th of the next year, another $50,000 comes out. Every single year until year 10. You don't have to think about it. The math is already done. The distribution happens automatically. You stay in control of the tax outcome. No surprises. No stress. Step 7. Every December of year 9, call your custodian again. Confirm the balance of the inherited IRA. Confirm how much you need to withdraw in year 10 to empty the account completely. Make sure the final distribution hits your account by December 31st of year 10, not January 1st of year 11. December 31st. That's the deadline. That's the law. That's the hard stop. Step 8. Track your annual distributions. Keep records. Every withdrawal. Every deposit. Every year. For the full 10 years. When the IRS audits you 10 years from now, you'll have the documentation. You'll have proof that you followed the rule. You'll have proof that you emptied the account by the deadline. Step 9. Consider whether to convert inherited traditional IRA distributions to Roth. When you take distributions from an inherited traditional IRA, that income is taxable, but you're distributing it anyway. Consider rolling some or all of the distribution to a Roth IRA. You'll pay taxes on the conversion, but the Roth grows tax-free forever. Your heirs inherit it tax-free. This is a strategy worth discussing with a tax professional. Step 10. Review your plan annually. Your life changes. Your income changes. Your tax bracket changes. Every December, review your projection for the following year. Adjust if needed. Your 10-year plan should be a living document that evolves as your situation changes. One more thing. If you inherited a Roth IRA instead of a traditional IRA, the 10-year rule still applies. But the tax treatment is completely different. If you inherited a Roth IRA, the distributions are tax-free. You don't pay federal taxes. You don't pay state taxes. You don't pay anything. $500,000 inherited Roth. You withdraw it over 10 years. You pay zero in taxes. Zero. Compare that to a traditional IRA. $500,000 inherited traditional. You pay $87,000 in taxes if you spread the withdrawal. You pay $251,000 if you take it all at once. Roth is worth 35 to 40% more than traditional when you inherit. Same inheritance. Same amount of money. The Roth is worth thousands more because of the tax treatment. If your parent has both traditional and Roth, tell them this. Leave the traditional to charity via your will. Leave the Roth to your children. That's the smartest way to structure it. Leave traditional to charity. Your charity gets a tax deduction. The traditional IRA never gets taxed. Leave the Roth to your kids. Your kids inherit tax-free. That is good tax planning. Remember Jennifer from the beginning. She inherited her mother's $500,000 traditional IRA. She didn't understand the 10-year rule. She didn't understand that December 31st was a deadline. She didn't understand that there were no annual distribution requirements. So she waited. She took no distributions for 9 years. Year 10 came. She withdrew the entire $500,000. She paid $251,000 in taxes. She could have paid $181,000 if she had spread the withdrawal. Jennifer lost $70,000 because nobody explained the inherited IRA tax bomb. Nobody explained the rule before she inherited. But her brother just inherited his own IRA. He's 38 years old. His inheritance is $400,000. He's doing it right. He's spreading the withdrawal over 10 years. He's staying in the 24% bracket. He's going to pay $80,000 in taxes instead of $152,000. He's saving $72,000 because he understood the math before he inherited. You now understand the math. You have 10 years. But start planning now. Today. Right now. Call your custodian. Get your statement. Build your spreadsheet. Do the math. Because the inherited IRA tax bomb is real. And it's coming in year 10. Unless you disarm it today. Like this video. Share this with everyone you know who just inherited an IRA. Or who is about to inherit one. Or who might inherit one from a parent. Most people have no idea about the 10-year rule. Most people are going to lose tens of thousands of dollars in year 10 because they took no action today. Subscribe to Kevin Retiree Strategy. Hit the bell. Turn on notifications. Every single week, I break down the retirement and tax rules that cost retirees hundreds of thousands of dollars. Comment below. Tell me, did you inherit an IRA? Are you facing this decision? Did you do the math, or are you going to wait until year 10? Let me know in the comments. I read every single one. This is Kevin with Kevin Retiree Strategy. I'll see you next week.